This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're going to talk now about financial assets. What happens when you first buy them, and then later what happens at the first balance sheet date. So when in your notes it says initial measurement, that's what happens again on the date of purchase. So on the day when we first buy that financial asset. So initial measurement is the date of purchase. Subsequent measurement is at the end of the year. So that, for example, would be at the SOFP or the balance sheet date. When we think about financial assets, we're going to focus on two types. One would be an investment in shares of another company, and the other one would be if you lend money to another company, so shares and loans. First of all, we think about initial measurement. That's very simple because if you pay 10 for something, whether it's PPE or shares or loans, if it costs you 10, that's normally the value at which it is booked. So you can see, if you look in the notes, that when I initially measure financial assets, I will initially measure them at fair value. Fair value at the end of the day means normally the price that you've paid for the asset. So how much did I pay? That's the opening figure that would be in the balance sheet. Sometimes a company has to pay transaction costs. Transaction costs are things like the commission that you might have to pay to a stockbroker in order to acquire the financial asset. So transaction costs here would be things like commission. Sometimes that commission is capitalized. It's added to the cost of the asset. Sometimes it's expensed. We'll see the difference as we have a look at the different categories of assets in just a moment. So we're going to start by looking at shares, and then afterwards we'll have a look at lending money to other organizations or debt. So shares first of all. So I've bought, again, some shares in another company. The question is, have I bought the shares for the short term or the long term? So again, there are different rules depending on whether the investment is a short-term investment or a long-term investment. Sometimes people buy the shares because they just want to see if they can make a profit or loss quite quickly. Perhaps the business is a stockbroking business itself. In that case, if it buys the shares for short-term gain or loss, then the shares are measured at fair value, they're remeasured every year, and if it's short-term in terms of investment, if it's a short-term investment, in that case, gains or losses go to profit and loss. If, on the other hand, you're buying the shares as a long-term investment, as you would be, for example, if you were buying shares in a subsidiary company, gains and losses do not go to profit and loss. We don't want the profit and loss being distorted by day-to-day movements on the stock market. So gains and losses are stored separately. And the treatment is very like the revaluation of PPE. Gains and losses on PPE, as you know, go to OCI. Gains or losses on long-term investments once again, those gains and losses go to OCI. So very much like the treatment of PPE. Short-term investments, gains to profit and loss. Long-term investments, gains to OCI. Now, something you have to get used to is in the balance sheet, they're given very strange names. So you might say short-term and long-term investment would be a sensible name, but we don't use those sensible names. Instead, short-term investments are called fair value through profit or loss. It's just a name. And long-term investments, again, are called fair value through other comprehensive income. And when you buy the shares, you have to make a decision about whether it's short-term or long-term. In the exam, they'll say it's short-term or long-term. The only other implication, the only other thing we have to be careful about are these transaction costs that I spoke about at the start of the lecture. Transaction costs are usually capitalised, added to the cost of the investment. However, as it says here, if you choose to treat gains and losses going through profit and loss, the transaction costs will also go through profit or loss. So we need to have a look at some example of accounting for shares, and then we'll have a look at the loans afterwards. If you go to example 2, there's an example with some financial assets. We're going to have a look at the first 2 parts of this, and we'll look at the debentures, the last part, later. Please read the first part of Norman. I'm going to assume that these shares, this investment, is a short-term investment. So I'll assume it is a short-term investment. And that means I'm going to classify it as fair value through profit and loss. Sometimes when you're looking at model answers, they will often use an abbreviation, and they will abbreviate this as FV, TPL, or maybe FVPL. Similarly, long-term investments, again, if you're looking at model answers, they will abbreviate sometimes FV, TOCI, or FVOCI, fair value through other comprehensive income. We'll have a look at this investment again, and that investment again on the 1st of November and then on the 31st of December. So we're looking here at example 2, and we're looking at the first investment. What we've said is that because it's short term, it will be classified as fair value through profit and loss. We've also said that transaction costs will be expensed directly in the profit and loss. On the 1st of November, that was the first date, wasn't it? On the 1st of November, we bought the shares for a £5. So the fair value of those shares is $5 each, and there are 500,000 of them. So if I was looking at a little miniature soft P on the 1st of November, I would say that I would capitalise or recognise them in the soft P at fair value. The fair value, 100,000 at $5. That would give me again a fair value of 500,000. When we go forward to the 31st of December, we will remeasure them at fair value. So I will remeasure at fair value in the soft P on the 31st of December. If we are lucky, the price has gone up, and if we're unlucky, the price has gone down. Well, it's bad news today, isn't it? Because the price has gone down to $3.50. So I would be very unhappy. However, the new value of the shares, 100,000 at $3.50. So the new value of the shares, 100,000 at $3.50, would be 350,000. The loss will be recognised in the profit and loss, the difference in the fair values. So also on the 31st of December, there'll be a loss in the P&L, the difference between the two fair values, $500,000 less 350,000. That would give me a loss of 150,000. What's important is that you always tell the examiner what goes where. So I'm saying at the end of the year, this is the figure in the balance sheet, 500. This is the figure in the P&L, 150, and it's a loss. Let's have a look at the second investment. When we read the scenario about the second investment, we've decided it's a long-term investment. That means the transaction costs are capitalised. That means that at the start of this transaction, on the very first day, I won't be booking the shares at 500. I'll be booking them at 500 plus 40, which is 540,000. We bought those shares on the 1st of March 15. So the last investment we said was classified as fair value through profit and loss. This one is classified as fair value through other comprehensive income. Transaction costs are capitalised. The date of purchase, we said, was the 1st of March 15. So if I was actually to extract a balance sheet on the 1st of March 15, I'd be saying that in the soft P, the shares would be recognised at the cost of the investment, which was 500,000 plus the transaction costs, which are 40,000. So the shares would be recognised at 540,000. Every time there's a year end, the shares have to be remeasured. This time, gains and losses do not go to the profit and loss. They go to other comprehensive income. So I can see at the year end, I'm just highlighting this now in blue, the value of the shares is 620. So the carrying value has increased to 620. Before remeasurement, it was 540. The gain will go in other comprehensive income. So here I am now at the balance sheet date. That's the 31st of December, 15. In the soft P, the shares are now remeasured at fair value. The new fair value, we were told in the question, was 620,000. So all the time what you're trying to do, remember, is to tell the examiner what goes where. So that's in the balance sheet. And there's a gain on those shares. So in OCI, other comprehensive income, I'll recognise the gain on those shares, the difference in the carrying value, the difference between 620,000 and 540,000, and that's a gain of 80,000. In this scenario, though, there's a little bit more. Because if you look at the last sentence, it says that in the next year, the shares were sold for 650. So there's going to be another gain, isn't there? The difference between 650 and 620, another 30. The question is, where is it recognised? If you look directly above the example, you'll see the rule. When we sell a financial asset, so when we sell a financial asset, obviously we take it out of the books, we de-recognise it. There will be, again, a disposal, and you'll notice here at the end of the day that if the gains or losses are going to OCI, then essentially even the gain or loss on disposal will go to OCI as well. So there are two possibilities. If the investment is fair value through profit and loss, then the gain or loss goes to P&L. If the investment is fair value through OCI, the gain or loss goes to OCI. The rule changed some time ago. If you are looking at some very old exam questions, they may talk about the gain or loss being recycled. That no longer happens. So it's a very simple rule. Look at the category. If it's classified as fair value through OCI, that's where the gain or loss goes. Just there and nowhere else. So in my example, the sale, this is the second example in example 2, the sale of the investment was on the 31st of Jan 16. So here we are on the 31st of January 16. That's the date of sale. I will de-recognise the fair value through other comprehensive income, investment. The gain, because it is a gain in this case, will go to to OCI. So a gain will be recognised in OCI. That gain is the difference between the proceeds, and the proceeds were 650, and the current carrying value, which is 620. So that's a gain, isn't it, of $30,000. So in terms of shares, we're saying, look at the classification. They'll tell you in the exam, probably, if it's P&L, everything to P&L, and if it's OCI, everything to OCI. But there's another category of financial asset. In addition, it could be, of course, that we've actually got a long-term loan, or of course it could be a short-term loan, in other words, a debt instrument. Debt instruments, Harry lends some money to Barry. So in that case, Harry has a financial asset. The question is, how do they measure it? In 99% of cases, debt instruments are remeasured using amortized cost. In other words, we don't think about fair value. When you value PPE, you talk about depreciated cost, and we don't worry about that. When you value intangibles, you talk about amortized cost. We don't worry about that. When we talk about financial assets, we also talk about amortized cost. And I say again, don't worry about it. Be calm. But amortized cost, the main thing is we don't take account of the current fair value of the debt. We are just concerned with using cost accounting. Take into account the cash flows with the instrument, again, that are going to take place, and the period of time over which they'll take place. So in most cases, if you look at the notes, the normal situation is what you can see in the big red box. So that is normal. In other words, use amortized cost. If I lend some money to my brother, the assumption is I'm not going to sell it to someone else. I'm not going to trade it on the stock exchange. So the business model is simply, I intend to hang on to the asset until my brother repays me. The cash flows are very simple. My brother will give me interest at 1% a year or something, and he'll repay the loan at the end. So essentially, normally, the only contractual receipts are simply the interest and the capital. On that assumption, we use amortized cost. You learned about amortized cost when you studied financial reporting, and I will do an example now, but if you're struggling, you might like to look back at our financial reporting notes and lecture just to remind yourself. So we'll have a look at amortized cost and then come back to this other point in the notes. So we're going to be in the last part of example 2. Pause the recording if you want, just to read the third investment. With amortized cost, the interest rate that goes into the profit and loss is what they will describe in the question as the effective rate. So again, it's the effective rate, or the internal rate of return. So that's the figure again that is used for the profit and loss. Don't panic about this word 2% discount. So if normally you have to pay 100, but we pay 2% less, we all know, don't we, that means we just pay 98. So whether you're buying a bed or an investment, a 2% discount means £2 off, 98 instead of 100. So essentially, we've got these debentures, and initially, of course, they'll be measured at fair value. That's the value that we initially paid. So when we have a look at this, I'll just write in the margin AC for amortized cost. So we're now having a look at this third investment. On the date when I initially bought it, again, so it will be recognized at fair value. So again, so initially, first of all, like all investments, recognize at fair value, and that's the price paid. So essentially, I've got 10,000 times 100 less 2, or 98 if you prefer. Let's just put 10,000 times 98. We have to be careful, don't we, with all of those zeros. But it looks to me like 980,000. So to make the number simple, I'm just going to put them in $1,000 terms. There we are, 980,000. At the soft P date, we would remeasure using amortized cost. And I think you probably learned a working for that when you did financial reporting. Some people write the working across the page. Some people write it down the page. I think it's easier to write it across the page, but it's up to you. So in the working, I'm just going to work out, I'll leave myself a nice bit of space there. There we are. I'm going to reconcile the figure in the soft P, or the balance sheet, at the start. I'll measure that in $1,000. So this is the first year. At the start, the value is 980. The balance sheet value is then increased by the figure that goes in the profit and loss. This is finance income, again in $1,000. Use the effective rate given to you in the question. The effective rate was 5.71%. 5.71% of 980, and I'm going to round, is 56. That's the income in the profit and loss. Now I deduct any cash flow, because during the year the debtor will pay me money. So that's any cash which is received. You'll be given a rate for that as well. In this rate case, they call it the coupon rate. The coupon rate is 4%. That's always worked out on the nominal value of the loan. Before the discount, this was $1 million loan. So if I round down, 4% of 1,000, so the cash received is 40. So in the closing SOFP, I've got the carried down $1,000. So my closing figure for the investment is 996. That will be the figure that goes in the SOFP. So at the end of the year, 996 in the SOFP, 56 in the profit and loss. You'll only be asked about the first year, I'd have thought. In the second year, the calculation repeats itself. So you would start with 996. The P&L charge would be 5.71% of 996. The cash flow will always be 40, and that's how we work our way through the calculation. But I'm sure we only have to worry about the first year. The last point about debt is that sometimes it could be that these tests don't apply. In other words, you are a dealer in debt. So you buy and sell debt issued by listed companies or issued by the government. So using US jargon, words like treasury bonds, in which case you're not planning to hold them to redemption, you're a bit of a trader. In that case, the fair value, the current value of the debt is much more relevant than something using amortized cost. So what we're saying is that in much rarer situations, we may remeasure debt at fair value. As I say, if, for example, Walt Disney issued bonds which are traded on a stock exchange, I buy them on the stock exchange, I sell them on the stock exchange, then fair value is actually a more meaningful measure, and that's what would be used again to decide what figure would go into the SOFP.